Did you know that a company turning a profit could be in horribly bad shape? Did you know that a profit does not necessarily mean more physical cash for the company? Let us make you aware of the key differences so that you are more familiar with the core financial concepts relating to our company's financial statements as you embark on your career with us. Cash is essentially a highly liquid asset that is easily convertible and is readily available to be used to purchase goods, services, pay off debts, and settle bills. Cash is recorded in the cash flow statement, a financial statement that notes the flow of cash in and out of the company's accounts. Profit, on the other hand, is simply the monetary benefit reaped from the difference between the revenue earned from the business and the operating cost that goes into running the business. Profit is recorded in the income statement, a financial statement that summarizes the value of operational transactions in a given period, regardless of whether or not cash has exchanged hands. Most businesses use accrual accounting, which apply the matching concept where expenses are matched to their respective revenues, regardless of whether cash has been paid. For example, when a customer purchases a certain amount of inventory on credit, a profit is recorded on the company's income statement when the customer has not paid any cash for the transaction. In the same way, the company does not record the inventory expense until they are sold. The illusionary difference between cash and profit to the untrained eye brings about the apparent discrepancies between profit values in the income statement and the cash flow statement. The income statement takes into account some expenses that do not appear in the cash flow statement, such as prepayments, depreciation expense, and bad debt provisions. The difference between cash and profit can be illustrated by companies at the ends of the spectrum: cash-rich but unprofitable, and profitable but cash-poor. There are companies that are cash-rich but unprofitable, making losses but are able to keep up with their expenses as they have large reserves. An example of this is the shopping giant Amazon. This company managed to raise $20 billion in shares in the 90s, and despite making losses each year consecutively, they were able to afford the expenses to keep the company going due to their large cash reserves. It took them a full decade before they started turning an actual profit, but because of sound decision making and a thorough understanding of their financial reach, they are now in a position of being both profitable and cash rich. On the other end of the spectrum are companies that are profitable but cash poor. These companies often run into bankruptcy as they are unable to pay their bills. Let's say a furniture company purchases $100,000 worth of equipment in a given year, serving to increase the assets of the company. On the cash flow statement, it will reflect an outflow of the full $100,000. But when it comes to the income statement, only the depreciation amount is recorded as an expense. Assuming a 10% depreciation rate of the equipment, this means only $10,000 is reflected as an expense in relation to sales in the same year. This can be a dangerously misleading concept, as the net profit for the year will be higher than the actual amount of cash the business has on hand. If they were to expand their business based simply on the impression of turning a large profit, they may run into a horrendous situation of overtrading and overinvesting in capital assets for expansion, incurring expenses and debts that they may not necessarily be able to settle due to the limited liquid cash they have in the bank, which could inevitably lead to bankruptcy. I hope you now have a better understanding of how profit figures can be vastly different from cash figures. A wrong interpretation or overestimation of a company's wealth could spell the end of its life. Being too eager in committing funds as a result of apparent profits is a textbook example of bad business decision making, and it has happened in the real world all too often, which our company will strive to prevent. A sound comprehension of the various concepts discussed in this presentation will surely lead to a more secure and prosperous future for our company.